cash budget, if we go back to our GAAP thinking, right, we're putting on our financial accounting hats. What does our statement of cash flow show? Well, we have beginning cash, we have ending cash, and we have what we use the cash for. Cash budget's going to be relatively similar. It's beginning cash balance plus whatever we expect to receive, that's cash receipts, plus whatever we expect to spend equals our preliminary cash balance at the end. And then we'll see if it's adequate or inadequate. Adequate means that, hey, we have enough for our operations to repay our loans and continue to operate. If not, we may need to borrow, use our credit cards, or take on some additional loans. And so from a cash budgeting perspective, we might get this kind of information that 40% of our sales are for cash, right? If we're a manufacturing company, a lot of our sales won't be for cash. A lot of them will be for credit. That doesn't mean it's on credit cards, right? It means that we're giving them accounts payable terms. So they're saying that 40% of our sales we sell for cash. The rest are paid a full month after the sale. And so we'll have to check this out from a cash for the cash balance. So our sales, we'll have the accounts receivable, right? That's the remaining amount. We have our sales and then our accounts receivable of 60%. Where do we get that 60% from? They said the remaining 60% are credit sales. That means our 60% is accounts receivable. So in September, our sales is 42,000 and our accounting receivable is 25,200. September, that's in Q3. We're not worried about that. We're about Q4. This is just know that you have to, in order to do Q4, October, November, and December, you have to go back to September and you have to figure out this ending accounts receivable to flow it through. That could be a trick question on one of your quizzes. So then we go to October. We know we have $60,000 in sales. We know that 60% of that will be accounts receivable. The rest will be cash sales. We collect cash today. And then we'll collect this $25,200 in the current month, right? Because it's a 1 month in arrears. And so then 24,000 plus the 25,200 is going to be the amount of cash receipts we have to use all of our purchasing activity in October. And this 36,000 will always be tossed to the next month in this kind of budget. When you get to cost accounting, we'll add things like allowance for doubtful accounts into this and make this can get much more complex. But for an ease of transactions and ease of calculating, we're going to keep it relatively simple here. So sales, the trickiest part here is just to remember to carry over your ending accounts receivable into the next month in order to do the collection of prior month's receivables. Now that we know how much cash we expect to receive, right? Going back here, budget our cash receipts. Now we need to figure out how much we're going to pay. So we're going to have to pay for material. We'll have to pay for other aspects too, but let's just look at material because we'd have to pay for salaries and all of that, SG&A. So for materials, we're saying that we got this from our direct materials budget. We need 10,240 in direct materials, but we're saying that we can put off the portions by a month. Full payment is made 1 month following the purchase. So they have net 30 payment terms. So even though they had materials purchased of 10,240, here, we don't have to pay anything in the current month because we pay 0%. We pay everything 30 days away. But the prior month, which information we'll receive, was 7,060. Here they got from the accounts payable balance on September 30th on the balance sheet. And so then our total cash payments is always going to be for the prior month. So 760, 10,240 from October. What we purchased, we'll be due in November. Let's do in November. What we purchased in November will be due in December. So just keep organized where this information is going when we have our payments. And so we figured out our budgeted cash receipts, our cash payments, then we have our preliminary cash balance. We just did the materials to keep it simple. And so we have some additional information added here that at September 30th, we had an additional $20,000 in cash, but we have to pay a dividend to our investors of $3,000 in November. So we have income tax payable of $20,000 from the beginning balance. We'll purchase another, and we're also planning on purchasing another $25,000 in equipment. We have an agreement that we have, this is called a bank covenant, that we have to have a minimum cash balance of 20,000, pays interest each month equal to 1% of the prior month's ending loan balance. I know this is a lot, right? But we'll just take it one piece at a time. Repays loan when the ending cash balance exceeds 20,000, owes $10,000 on this loan arrangement of September 30th, has 40% income tax rate, and will pay taxes the current year. So something I want to pause here, right? Not my favorite way of presenting this information, but it's useful for us to just walk through how this is what a real cash budget will throw at you. But I'm going to break it down to each piece, and just know on your quizzes, just go one step at a time, right? This will just be one problem. If it's on your test, I'll just ask one purchase of this. I'm not going to ask you to make a full master cash budget. We'll save that for cost accounting. But just know that it can be this intense, but I want you to take it the way we've been taking all the previous slides. We're just one fact pattern at a time. This multiple fact patterns being dumped at one time. You might get a test question like this and your homework, but and it's useful to work through just to understand how a budget would work, but just don't be overwhelmed. Just take it one step at a time. And so here we have our beginning cash balance, which we talked about. We started with 20,000. Let's just do October. We know where we got our cash receipts from customer. We did that together. Total cash available. This is our cash receipts budget. We know how we did our direct materials budget and our direct labor budget and our variable overhead, sales commission. We did all of this stuff together, general and administrative expense. We already did all of that. That's just pulled from prior examples. What we haven't done yet is our income tax payable. Where did we get this income tax payable from? We just added this here. We said, oh, you have $20,000 payable at the beginning of the balance. So it's payable. We're going to pay it in the next month. So we're going to assume $20,000 we lose out here. The remainder, we'll still have to work out the interest and all of that. We'll work down. But I just want to show that all this other information so far is we've calculated together. And so income tax of $20,000 were due. We next subtract the expected amount. And then we had a $10,000 loan. And so where are we getting the $10,000? We owe $10,000, right? So we went here. This is where they get this information from. We owe $10,000 on the loan, and we pay interest equal to 1% from the prior month's loan balance. So we owe $10,000 on this loan, and the interest in October is 1%. So we have $100 of interest expense. Are there any other fact patterns here that we need to be concerned with? So we're going to purchase this in December. Worry about it in December, right? We can plug that away later. We pay the interest. We repay the loan when the ending cash balance exceeds 20. It's not 20,000 yet. It's still 10,000. That's fine. 40% income tax rate. We'll have to do that. Add that in. And so we have $100. Total cash payments is $43,565. Total cash available $69,200. We subtract these two to get our preliminary cash balance of $25,635. And then we're going to repay a portion of the loan to the bank to get our ending cash balance of $20,000. How do we determine that? We say that we have an agreement that requires us to maintain a minimum cash balance of $20,000, and we'll repay the loan when the ending balance exceeds $20,000. So all we're saying here is whenever we have more than 20,000 bucks, we're going to use that extra money to pay back our loan so we don't have to pay so much interest. So 1% interest every month, that's 12% a year. That's pretty high. And so we paid down our loan by this remaining amount. Sometimes they'll say in the questions you have to do it in thousands. And so we have a remaining loan balance of $4,365. We go to the next month. We know where we got all this information. We got it from our previous ones. We've already paid our income tax payable. But this time we have dividends. Where do we get dividends from? Dividends were here. So our interest expense went down because we paid off some of our loan. Our total cash payments are $31,954, which is just the sum of all this. We subtract the receipts minus the payments, get our preliminary balance. With that preliminary balance, we can pay back the rest of our loan and we have excess of cash. Now that we have an excess of cash, we go through this all again. We don't have anything else we're supposed to worry about except our purchase of equipment. We purchase our equipment for $25,000. Our total cash payments are $56,575, and now we have a remaining cash balance of $44,706.